Good morning, ladies and gentlemen. Risk dials is down this morning, but we will fix it at some stage. I apologize for that, but there's nothing significant that it's showing. I have the email with all the data, and really I can't see anything there that is telling us where we are or where we're going. Now, the big news is the disinversion that is taking place, i.e. the steepening of the yield curve. And let's have a look at that together. Let's have a look at what twos are doing. Well, I think twos have an appointment with 404 very, very soon, and then quite possibly down to the 369 area. And I think that's where it's going to stop, and that's the target. But I think it's going there in steps. But let's have a look really at the difference between what the charts look like in each individual tenure. So that's twos, that's threes going with the twos. This is fives going sideways. This is tens really higher than they were, and this is thirties right at the highs. So it's all about the yield curve and how it's flipping. Now, it's interesting to talk about why it's flipping. It's flipping because of Waller. It's flipping because real rates are too high at the front end. The Fed has realized that, and it's still looking for inflation to come down to target towards the latter half of this year, and then to start normalizing rates with real rates of Fed funds anywhere between 1.5 and 2.25. What that will give us is Fed funds which are somewhere between 3.5 and 4.25 by the end of this year or sometime at the beginning of next. If that is the case, as I keep on telling you, there's hundreds of billions of dollars in money markets, all invested in 1-month bills, 3-month bills, floating rate notes, whatever, and they have this huge reinvestment risk, and at some stage they have to basically put their money into fixed income, i.e. something with duration, and the market is front running that and making sure that they get in at the worst possible level. And that is not yet, right? So I just don't see any alternative to twos, threes to 5-year area continuing to do better until and unless CPI data negates that move. And the CPI we had this week was not special enough, and the PPI was weak. The weakness in PPI was really to be expected because we didn't really have anything go higher in the commodity space, so why should PPI be higher? And the market took the opportunity again to, how shall I put it, to squeeze the people who need to reinvest their money market assets into something with duration and lock in that duration. No one is going to sell twos and threes. It just isn't going to happen, it seems. So let's have a look at the yield curve and see what that is doing. I mean, let's start with the shortest, twos, threes, okay? That is the one that's going to move the least, but even that you can see is on its way down. So now let's have a look at twos, fives. I think 23 in twos, fives is now absolutely certain. And then we have some kind of a head and shoulders up here, which indicates to me that at some stage we will come down and we will have a positive curve even in that. Let's have a look at twos, tens. We are at the support at 16. I think if we break that support, we're going to minus 18. These are big moves. These are another, what, 30 odd basis points? So it pays to look back to where we were. And this kind of level seems to be a natural for that curve. But that leaves a great big head and shoulders. We go down there, retest to the high, and then we can come all the way down to possibly here over the medium term. So we are getting the disinversion that we were talking about. Real yields are going to be lower at the front end. And let's have a look at 530s. 530s are breaking down. To me, the level that we're going to see 530s at is somewhere around here. That's minus 57. That's another 20 basis points from where we are now. And finally, even 10s, 30s, which if you remember, we were selling here at negative rates, i.e. where 10s yielded you more than 30s. And that is now at 23, and I think we're going down here in this area, minus 35 to minus 29, so another 7 to 10 basis points lower. The whole curve is disinverting because it doesn't believe that inflation is going to be a problem anymore, and it's just a question of how fast the Fed is going to cut rates. Now, is it going to cut rates at every meeting? I doubt it. I doubt, though, that the Fed is going to push back at its meeting in January. And therefore, I think this trend of disinversion will continue. Park your money in 2s, 3s, 4s, 5s, and leave it alone. If we have a look at the German yield curve, the same steepening is happening there as well. The Schatz got to 268, and now it's basically going to come down and retest the 225 area. So Schatz is definitely not a short. Okay, do not get tempted to short it. When the Schatz moves, it can move very quickly to the upside. Let's have a look at the yield curve basically. 2s, 5s. I think Schatz bobble will retest 35, so that's another 8 basis points of steepening. 2s, 10s, I think it tests this 25, 26 area. And 2s, 30s, it will retest this 9 and then go down to 13. But let's have a look at where it came from. Eventually I see it back down to these levels, minus 49, so that's another 60 basis points that you're going to get at some stage. That is basically what is happening. It's the yield curve is normalizing, and you should like it. Let's have a look at the individuals. This area here I think trades. Bobble, I think we will at some stage see 160. And Bund, I think it's going to be the one that moves least, but I have no doubt that it's going to keep on doing this kind of behavior that we had here, and at some stage we will test around the 178. I don't think it goes through it. I think all the value is going to be in timing the short end and where, how much of the steepening we get when. I think at the moment there is absolutely no alternative to playing the Schatz and all to the long side, just like in the US. If we look at the spread between Germany and the US, it's actually, the US is leading this move. But I think the explanation is very simple. It's not that the Fed is going to be more dovish than the ECB. It's that rates are higher and therefore there is more room to cut in real terms by the Fed rather than the ECB for the time being. So twos, I do believe they go back towards this 150 level. So, playing in twos US is going to be slightly more profitable than playing in shads, but it's marginal. Fives, I don't think they move a million miles. They are at support at this 175 area. And I think it's going to be very, very tough for them to trade much through this 160 area. That's about as far as they're going to go. And tens, I think 172, which was the level that we caught the break of, is going to be very good support. I find it very difficult to believe that we are going to do anything but what we did here, i.e., just meander between 152 and 190. So yes, I do prefer the US overall at the moment, but I don't think they're going to be impulsive moves. I think they're going to be, sideways to surprising to the downside, squeezing people out and that kind of thing, which tells me that the dollar overall is going to be weakish, but not in trend. So these differentials, I think, are just going to bounce around, and 172 you will probably see many, many times over the coming weeks. It's not going to be in the tens. It's going to be more at the short end rather than anywhere else. And that tells me that the steepening is almost certain to continue over the course of the rest of the month. And don't forget, we have the QRA at the end of this month. If we get a lot of duration issuance, I don't think it's going to happen, because I don't think why Janet Yellen would shift to bills and then a quarter later shift back to duration. I think that's fanciful, but if it does happen, the steepening is going to be just enormous. So the risk reward actually at the moment is definitely on the steepener, and the real surprise could be another steepener. So until the QRA, everything steepens, and on the QRA, the risk is that it really steepens. So you have your trades, any kind of bounce back, you buy twos and threes in the US and you forget about it. Given what the bonds are doing and the differentials, you already know what I'm going to say about the dollar. And you can see what it's done in the past week. It's done absolutely nothing. But I think the risks are that it comes down to towards this 101, 80, 90 area, and possibly down to these levels around 101. But it's going to be limited, simply because I can't see that the differentials are going to move that much. It does favor, the US is going to probably come down more, and therefore the dollar should be under some kind of pressure. And if we have a look at the euro chart, what am I talking about? I'm talking about pressure up to here, 110.65. That's the kind of pressure I'm looking for. I'm not looking for anything impulsive. I think it's going to be difficult to break this level sustainably, but I think it trades. That's basically as far as I'm prepared to say what I think about the dollar, and I'm leaving it alone simply because these moves are too small for me to care, and they're not going to be impulsive, and therefore I'm probably going to see all these levels again. And really, this is not what you're supposed to be trading. You're supposed to be trading the yield curve. Gold, I do see small upside, nothing fanciful. Geopolitics might add a little bit of a bid to it, but I don't think it goes a million miles. I certainly don't think that it starts breaking down below this 2010 area. I see no reason for it. I don't think bonds are going to, the long bond is not going to pressurize gold, and I don't think the dollar is going to pressurize gold. So this 2010, 2020 area is going to be support, and really where is going to be the resistance, where it's going to be around this 2090 something. I just can't see it maintaining 2100 and staying there. I think it does something like this, several weeks of going up and down between 2110 and down to 2050, where we are at the moment, or slightly lower. There is no impulsion, I feel, in gold at the moment, because there is no impulsion that's going to be shown in anything but the yield curve movement. If the yield curve is pivoting around the 20s and 30s, real rates aren't moving very much. The long-term real rates aren't moving very much. And in that case, what's really going to support or make gold go up in an impulsive sort of way? It's at extremes is 2140, 1980. What do you want to do? I would be a better buyer around 2010, because I think the odds are that it does go higher from there than it can go lower. But I just don't see that this is going to be an impulsive market for the foreseeable future. I think what you want to be doing is you want to be trading the yield curve instead and going aggressively long of, twos, threes, and fives. That, I think, is going to have a better reward. That can move 5% in 2 days. Go from, 410 down to 390. So that's 5%. You're not going to get 5% from gold. That is all I'm saying. I'm not saying I don't like it or anything like that. I'm just saying it's not going to be impulsive, because the drivers of it aren't impulsive. DBC actually was very disappointing to me last week, because if you remember, I told you that I think you should be long of it at that level, 2175. And yes, it closed at 2206, but it had the opportunity to trade quite a bit higher on the Houthi rebels and what have you geopolitically, and DBC is all 60% oil or something. So oil had the opportunity, and therefore DBC had the opportunity. And yet the move up was very, very timid and really nothing much to write home about. So disappointing. And this level here at 2175 is basically where we started in 2022, and in the second week of 2022, and then we spiked with the Ukrainian war, and we are right back to it. And we are really not being impulsive, we're being corrective. So if all it does over the course of a month is come back up to, 2280, 2300, and it takes several weeks to do that, that actually is going to be very, very disappointing to me, and tell me that the next move is actually likely to be lower. It's difficult to understand why that would happen, because we're not really in a period of deflation, we are in a period of disinflation. And if you have a look at this chart, and I'll enlarge it, you can see that basically prices are back at 2015 levels, when it's not like we had a roaring economy or we had, anything roaring. So it's a bit disappointing, because if it starts going through there, this 2175, we're looking for support not before this 1947, and that's another, let's call it 5-6%. So it will give bonds much more room to rally if that were to happen. I don't know whether it's going to happen. I'm going to be watching it very, very closely. Let's not forget that this 2050 is the 50% retracement of this whole move, and we do have the 200-week moving average coming down at that level, so 2050 should be a damn good area for a bounce. I mean, damn good. But from 22 to 2050 is another 6-7%, right? So it's difficult to be buying DBC right now, because there's no sign that it wants to be impulsive to the upside. Had it wanted to be impulsive, it should have closed right at the highs this week, and it didn't. So that tells me that there's still room for bonds to rally, and therefore I will be playing bonds rather than DBC and oil and everything else. And if you can look at oil, you can see what is so disappointing about it. It had the opportunity on Friday to close right at the highs around 75.23, and what did it do? It came right back to where it opened. And a red candle on a day like Friday is terribly, terribly disappointing. So if oil can't break this 75.20 area, DBC can't go any higher, because copper is closing right at its lows, and it's just not impulsive. And if that is not impulsive, it gives bonds the opportunity to be impulsive. And therefore, I'd much rather play bonds than play DBC or oil or gold, as they are much more tied together. And if these aren't impulsive, I'd much rather trade something which is, and that is the short end of bonds. Before I look at equities, I'd just like to say that we are in a period of stable relationships between asset prices. Now, let's have a look at where the QRA was, and this is SPY TLT, and the last QRA was November 1st, right? This is exactly where we were. So you could have been trading SPY or TLT during that whole period from November 1st till now, and it would have made no difference at all which you picked. Relationships in general are stable. Equities and bonds, equities and gold, bonds and gold, real rates, i.e. tips and gold, everything is stable. Whatever you look at, it's stable. The relationships between these asset prices are not moving. I don't know what's going to make them move, but everything that you do in equities should be colored with that perspective that these asset prices are in lockstep. They're not moving. And therefore, if you don't see bonds move, it's very difficult to see an impulsive move to the upside in equities. I think it's just literally as simple as that. I think everyone is now going to be waiting for the next QRA on the 31st of this month. And before that, they're going to be waiting for core PCE. And after that, they're going to be waiting for the Fed. And after that, they're going to be waiting for the QRA. nothing really in terms of asset prices is going to be more than 1% different than it is at the moment. So if you have a reason to trade bonds, trade those rather than trade equities or commodities or dollars or whatever, because those are just going to follow what the bonds do. End of story. It's not more complicated than that at the moment. And while we are at spreads, let's have a look at SPY EWJ. So the SPY against Japan, that's the closest that I can do it against the Nikkei. And basically what happened there is that the Bank of Japan took away the fear the market had that their tightening is going to be substantial. And as soon as that happened, basically the relationship has gone back to where it was. And where will Nikkei stop? Well, the Nikkei will probably stop when we are at these levels of relationship between SPY and EWJ. If you have a look at EWJ against EWG, this is so Germany against the Nikkei, more or less, right? DAX against Nikkei. It's very overbought, but it's going to stop very soon. These kinds of levels are going to be very, very difficult for it to break anytime soon. 230, you want to be out of your Nikkei and redeploy the money to SPY and or the DAX. The Nikkei move is coming to an end. It's not a per se move of the Nikkei, although it is, of course, but it's a spread move against Germany and against the US, i.e. it's an unwinding of the moves that it had. You can see how much Germany appreciated against Japan, and this was because of the fear that the Japanese would tighten while the Europeans were easing, and therefore this move occurred. Now it's unwinding, but once it gets there, it's going to be very difficult for it to keep going, and that is when you want to actually redeploy money towards Germany rather than in the Nikkei. But for the time being, the Nikkei is still more impulsive than either Germany or the US, and therefore it's going to trade a little bit higher, I would have thought. And here is the Nikkei. Beautiful move higher, and you never stand in the way of a break of something like 34,000. So what is going to happen to it now? I don't think it goes much higher, simply because I just showed you what the relationship against the DAX is and what the relationship against the SPY is, and I don't think that those run away. And therefore, once it's made new highs and stopped everybody out, what I would have thought is that it comes back to somewhere around this 34,400 to 600 area. And there you want to really bite hard. So it's simple as that. I don't think it will go through 34.5. You want to be buying something like call spreads, or, if you have to buy the outrights, and I'm one of those who doesn't have an option here that is liquid and can trade. So 34.4, 34.5 is the level where you want to step in again. And one alternative is EWJ calls. So that is the trade again, which tells me that even if there is some kind of a pushback in the relationship between Nikkei and Germany and so on, it's going to be very limited. And therefore, I think that all the stock markets are going to be supported. Okay, not just Nikkei. I think all of them are going to be supportive. And you are looking for buy levels in everything. It's still risk on. there is still no reason for equities to go down, simply because A, bonds are supportive, and B, there is absolutely no reason to sell it unless you see a complete divergence from of all asset classes, and that must include bonds. So unless you see that, there is absolutely no reason to sell equities. On a 195-minute chart of the SPOOs, you can see the 46.97 level as being extremely, extremely important. And unless and until it breaks through there, you can't even see a dip down to 45.95. So there's absolutely no reason that I can see to short it. You're just looking for buy levels. And in terms of, targets to where it goes, well, very difficult to say, because that you can only get for something like a daily, and there is absolutely nothing up there. It's new highs, right? So the only other thing that you could possibly look at is here, the once it breaks above 47.96 on the clean chart, I have really air above. I don't think that that is likely to really happen, or that we can safely say that we've left 47.96 in the dust until the QRA. So another, what is that, 17 days? Then we will be able to say that if coupons aren't added in a dramatic way, and we will have, I'll have all the triggers for you and all the quantities, then we can probably see a continuation of this move higher, all the way to, I don't know, another 5%. Normally when it breaks by 5%. That's all, that's the rule of thumb that you can use, and you can see that it's not overbought at all. It can go quite a bit higher until it gets overbought. So that is what you're looking for. You're looking to buy any downdraft, buy options or whatever, and just sit with it. But again, as I've been saying since the last QRA, I just can't see a single reason why you would want to short equities. It's just beyond me. There is no doubt that European equities are being sold against Japan and probably even against the US. But I think that if you see 44.30, you want to be buying some call spreads. I think they're not going to lag behind forever. And 2-3 month call spreads at 44.30 is the right play. They are a good nearly 100. What will that be? That will be nearly 200 points lower than the highs, and I certainly think that they revisit the highs at some stage. That is all I can say about equities. I'm a dip buyer whenever I get the opportunity. In summary, all you're looking for is for the disinversion to take place. And, at any moment it could become impulsive. I don't think it's going to become all that impulsive until the QRA, but after the QRA it could become really impulsive. So, it's still going to move before the QRA, and I think until the QRA, all you're really supposed to do is play the yield curve. And then after the QRA, really play the yield curve potentially. But we will see. I mean, there's no point anticipating what the QRA will say. I just don't see anything better than bonds and the short ends of bonds rather than anything else. I just know that any dip in equities is going to get bought simply because any dip in bonds is going to get bought. and the relationship between all the asset classes is stable. Something dramatic needs to happen for that to break, and it has to be fundamental news. It's not going to break just because somebody does something. It has to be fundamental in terms of some news or some reasoning that changes that. And until that happens, it's just not going to move. These asset classes are going to remain stable, and therefore no reason to sell anything in terms of risk. Thank you very much indeed. Have a wonderful bank holiday weekend, and tweet you tomorrow.